Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me. I'm really excited to get into this one.
Yeah, so today's deep dive is, well, it's about a massive shift happening right under our noses in the financial markets. And I mean massive.
Oh, definitely.
We're talking about money flooding into the energy sector, but this isn't just some boring financial stat. It's an absolute structural shift in how the whole world values energy security.
Right. It's changing everything.
Exactly. So for everyone listening right now, whether you're looking at your own 401k or your investment portfolio, or you're just wondering why the global economy feels so jittery lately, understanding this shift is basically the ultimate cheat code.
Yeah. And just to jump in here, I want to clarify something right off the bat. We aren't just talking about, a temporary spike in gas prices at your local station.
Right, right. Not just pain at the pump.
Exactly. What we're looking at, according to recent analysis, is a fundamental revaluation of assets. This is the kind of thing that will define the next decade of investing.
Wow. Okay, so to understand the future of energy, we really need to follow the money right now.
Always follow money.
Always. Where is the capital moving? And what does that tell us about investor psychology? Let's look at the data.
Sure.
So in March alone, a staggering $2.1 billion flowed into global energy sector funds.
Which is huge.
It is. I mean, that's near the strongest monthly flow we've seen since, 2014?
Yeah, that's right. And to put that in perspective, the top 25 global oil companies saw their market cap grow by about 20% this year.
20%?
Yeah, hitting $5.3 trillion.
That is, 5.3 trillion is a number that's hard to even wrap your head around.
It really is. And if you look at the indexes, the MSCI World Energy Index jumped 29.5%. Meanwhile, the broader MSCI World Index, which covers pretty much everything else, actually dropped 1%.
Oh, wow. So energy is just completely decoupling from the rest of the market.
Exactly. And the reason for this, based on the research, is that energy is no longer seen as just a cyclical stock.
Okay, wait, let's pause there for our listeners who might be beginners. A cyclical stock is basically one that goes up and down with the economy, right?
Right.
If the economy is booming, people buy more stuff, factories run more, so we use more energy. But if there's a recession, it crashes.
That's the perfect definition. But what's happening now is that investors are treating energy as a value stock.
A value stock.
Right. They see it as a hedge against all this geopolitical chaos. It's a defensive play, though I should clarify. It's a selective relocation of capital, not a total market panic.
Oh, how so?
Well, money is still flowing into industrials and tech,
Yeah.
But notably, traditional safe havens like gold and precious metals,
Yes.
they actually saw massive outflows.
Huh. That is fascinating. So to use an everyday analogy, it's kind of like investors were all eating at this trendy, experimental tech restaurant, right?
Like this.
And suddenly, a bunch of them just got up and walked across the street to the old school steakhouse, the energy sector, because they looked at the sky and realized, oh, wow, we actually need a heavy, reliable meal to weather this approaching storm.
That is exactly what's happening. They want something solid.
But let me push back on this a little bit. Looking at the data and the news we see every day, isn't this just a knee-jerk reaction to current events?
You mean the war headlines?
Yeah, exactly. Once the news cycle calms down, won't this money just flow right back out of the steakhouse and back to the trendy tech spots?
It's a fair question, but no.
Mhm.
The data suggests otherwise. The war is really merely exposing a fragility that has been building up for years.
Oh, really? So it was already broken?
Yeah, the real issue is a deeply rooted lack of supply resilience. The market was already running on empty. It was just waiting for a shock.
Okay, but what about the U.S. government? They released 400 million barrels from the strategic reserves. They eased sanctions. There are indirect exports happening. How is that not enough to fill the gap?
Because it's a drop in the bucket compared to the structural deficit. Just look at the recent CERAWeek conference. The U.S. shale industry explicitly stated that even with oil sitting over $100 a barrel, they are not going to aggressively increase production.
Wait, really? If oil is at $100 a barrel, why wouldn't they just drill more and make a ton of money?
Because of the conditions. They won't do it unless those prices hold for more than a quarter.
Oh, I see.
Yeah, their capital expenditure or CapEx plans for 2026 are highly conservative.
Because they've been burned before.
Exactly. Costs are rising, productivity in the newer wells is lower, and there's a strict, undeniable focus on prioritizing shareholder returns. Investors want dividends, not expensive new drilling projects.
Wow. Okay. But even with this stubborn supply, short-term prices are still incredibly volatile, right?
Oh, absolutely. They swing wildly based on political news. For instance, when reports surfaced that the U.S. sent a 15-point ceasefire proposal to Iran,
Right, I remember that.
Brent crude dropped to $98.28, and WTI dropped to $87.68,
Just off a rumor.
just off a rumor. That was a massive plunge of over 5% in a single day.
So the current geopolitical conflict is really just the match that lit the powder keg. But the powder keg itself was built by years of underinvestment and a slow supply response.
That's a great way to put it.
But if crude oil supply is this stubborn and prices are still swinging wildly on political rumors, what is the actual underlying bottleneck in the global system right now? Like, where is the real pressure point?
If you look at the recent analysis, the real pressure point isn't actually crude oil.
It's not.
No. It's the far more complex and rigid world of natural gas, specifically liquefied natural gas, or LNG. The current crisis is hitting natural gas way harder than crude oil.
Okay, why is that? Why is gas so much harder to manage?
Simply put, gas is incredibly hard to store and replace. Moving LNG requires highly specific infrastructure.
Like what?
You need liquefaction plants to cool the gas down until it turns into a liquid. Then you need specialized transport ships. And finally, regasification facilities at the destination to turn it back into a gas.
Okay, so let me try to clarify the logistics here for a beginner listening. Crude oil is kind of like bottled water, right? You can just toss it in the back of a truck, put it on a standard ship, and easily send it anywhere.
Pretty much, yeah.
But natural gas is more like transporting hot coffee. You need a very specific, expensive, insulated thermos to move it safely. And if that thermos breaks, you're just out of luck. The coffee's ruined.
That is brilliant. Yes, if the thermos breaks, the whole system stops.
Yeah.
Let me give you a real-world example from the data. There was recent damage to Qatar's LNG facility. That single issue could wipe out 17% of their export capacity for an astonishing 3 to 5 years.
3 to 5 years just from one facility going down?
Yes, it's that fragile. Qatar Energy even declared force majeure on their long-term contracts.
Wow. Force majeure meaning they legally just said, an act of God happened. We can't deliver the gas we promised.
Exactly. And that hit major countries like Italy, Belgium, South Korea, and China. They weren't getting the gas they relied on.
That sounds like a nightmare for those countries.
It is. The Shell CEO recently warned that Europe could face physical shortages as early as next month, and the German government is openly worried about shortages hitting them in April and May.
That's terrifying. Just regular people not having power or heat?
But beyond the crisis management, there is another massive structural demand driver that we have to talk about.
Oh, what's that?
Artificial intelligence.
Wait, really? AI?
Yes. AI requires an unbelievable amount of power for data centers. In fact, under the current administration, with President Trump prioritizing domestic manufacturing and energy independence, there's a massive push to reshore data centers and factories.
Right, bring the jobs and the servers back to the U.S.
Exactly. And to meet that massive power demand, the U.S. recently approved a 10-gigawatt gas power project led by NextEra.
10 gigawatts. That's a massive amount of power.
Huge. And it's specifically designed to feed those data centers and the reshoring efforts.
But wait. If natural gas is in such incredibly high demand and the infrastructure, the thermos, as we called it, is this fragile and bottlenecked, won't the pain eventually become just too much?
What do you mean?
Like, won't countries just be forced to find an entirely different way to keep the lights on? If the thermos keeps breaking, won't you just stop drinking coffee?
Well, you've just hit the nail on the head. That extreme pain in the natural gas market is exactly what is triggering a broader, decade-long structural shift.
Oh, so they are finding another way.
Yes. The research confirms that some consumers and nations are already pivoting away from gas because the shock is just too severe. It's too unreliable.
Do you have examples of who's doing this?
Absolutely. India is a great example. They are trying to strengthen their gas infrastructure, sure, but they are also actively reducing industrial LPG use and leaning heavily back toward coal.
Going back to coal. Wow.
Yeah, and South Korea is doing something similar. They're reducing gas power in favor of a mix of coal and nuclear energy.
So when people talk about a 10-year energy bull market, it's not just about fossil fuels like oil and gas.
Not at all.
It's a bull market for the entire energy security chain, whatever keeps the lights on reliably.
Precisely. The data shows investors are flocking to Chinese renewable stocks right now. Solar, wind, battery, and nuclear stocks all surged in March.
Because it's domestic, it's secure.
Right. Goldman Sachs and other analysts are actually predicting that these deep fears over energy security will serve to push massive, long-term investments into renewables and nuclear power.
It's like finding out your usual highway commute is permanently jammed, you know? You don't just buy a different car. You start looking at taking the train or buying an e-bike or just negotiating to work from home.
Right, you change the whole method.
Exactly. The bottleneck changes your entire system.
That's the structural shift we're talking about.
Okay, this all makes total sense macroeconomically, but for the everyday American listening right now, who wants to be smart with their money in this new world? What is the practical playbook? How do we invest in an entire system without getting totally overwhelmed?
That's the million-dollar question. And based on the recent analysis, I can lay out 4 key takeaways for everyday investors.
Epic. So let's hear them.
Number 1, prioritize discipline over excitement.
Okay, what does that mean in practice?
It means avoid highly volatile exploration stocks. The guys saying they're going to strike oil tomorrow. Instead, look for large integrated energy companies. Look at LNG exporters, midstream companies.
Let me pause you there. Midstream.
Yeah, midstream companies are the ones that transport and store the energy, like pipelines.
Ah, okay, like the toll roads of energy.
Exactly. Toll roads and refining infrastructure companies. You want companies that offer supply elasticity and capital discipline.
Meaning they pay strong dividends and do stock buybacks rather than blowing their cash on risky new drills.
You got it. That's rule 1. Rule 2, geography is destiny.
Geography is destiny. Okay, unpack that for us.
Where the energy is physically located matters more than ever. The U.S. and Canada are highly defensive and resilient markets right now because they have massive domestic resources.
And like you mentioned earlier with President Trump in the White House, there's a strong focus on maximizing that domestic production, which makes the U.S. even more of a secure bet for investors.
Right. The policies are heavily favoring domestic energy security. Conversely, Asian importing markets, places like South Korea, Taiwan, India, they are incredibly vulnerable right now.
Because they have to import everything.
Yes, they face a brutal double threat: high global oil prices and high U.S. interest rates.
Oh, because oil is priced in dollars, so a strong dollar makes it even more expensive for them.
Exactly. The data shows that foreigners actually net sold $50.5 billion in Asian stocks recently. $50 billion.
Wow, capital is just fleeing to safety.
Yep. Which leads to rule 3, the barbell strategy.
Like a weightlifter's barbell, heavy on both ends.
Right. If you're looking at natural gas, you want to invest in the whole LNG value chain on one side of the barbell. Exporters like Cheniere and Venture Global, storage companies, gas plants.
Okay, so fossil fuel infrastructure on the left side of the barbell. What's on the right?
On the right side, you balance that with long-term alternative demands, renewables, battery tech, and nuclear. You're covering both the immediate crisis and the long-term solution.
That makes a ton of sense. And what's the 4th rule?
Rule 4, expect volatility.
Naturally.
Right. A 10-year bull market doesn't mean prices go straight up forever in a perfect line. You should expect massive 5% drops based on political rumors or ceasefire talks, like we saw with Iran.
Right, the market will always overreact to the news.
It always does. But structurally, the 2010s era of energy oversupply is completely dead. The premium on energy security is here to stay.
So if I'm distilling this entire investment philosophy down for our listeners, the golden rule here is don't just bet your life savings on the guy digging for gold. Bet on the company selling the pickaxes, the shovels, and the train tickets to the mine.
Yes, infrastructure and security, that's the play.
Well, let's synthesize everything we've talked about today. The energy sector is no longer just a slice of the market pie. It is the table the pie sits on.
I love that.
It's an interconnected chain of security, resilience, and survival. While oil and gas are the short to medium-term powerhouses keeping the lights on, renewables and nuclear are the long-term anchors that countries are turning to so they don't have to rely on a fragile thermos of hot coffee.
That's a perfect summary of the data. It's a complete paradigm shift.
It really is. And before we go, I want to leave everyone listening with something to chew on.
Oh, lay it on them.
If energy security is the new global currency that dictates where trillions of dollars flow, how long until we see that same premium applied to everything else we rely on?
Oh, wow.
Right, from the food in our grocery stores to the microchips in our phones. Because at the end of the day, it takes energy to make and move all of it. If energy is fragile, everything is fragile.
That is a very sobering thought. but it's exactly where the market is heading.
Truly fascinating stuff. Thank you to everyone for tuning in. Don't forget to subscribe and hit that like button.